Welcome to Smart Money Moves with Rod Loyola. In this video, we're going to cover the 5 costly mistakes Muslims make when investing and how you may avoid them and get clarity and confidence when it comes to investing. Let's get started. But before I do, please do not forget to subscribe to the channel and like, comment, and share the video with those you may believe it will benefit. Mistake number 1, confusing intention with compliance. Most Muslims want to invest halal, but wanting something to be halal is not the same as it actually being halal. We assume that because we avoid alcohol, gambling, or obvious sins, our portfolio must be fine. But modern investing isn't simple ownership anymore. It's layered exposure, pooled funds, indirect financing. You can have sincere intentions and still unknowingly participate in structures that don't align with Islamic standards. Intention matters in Islam, but contracts are measured. Halal investing is not about how you feel about an investment. It's about applying measurable standards to what you actually own. Ethical is not automatically Islamic. Diversified is not automatically compliant. Compliance requires structure. Before investing, ask, what does this fund actually hold? Has it been screened using recognized Islamic financial criteria? And are revenue sources and debt ratios evaluated? Sincerity must be paired with verification. Serious Muslim investors don't guess their way into compliance. They apply structure because wealth is an amanah. Mistake number 2, assuming diversification means permissibility. Most investors think diversification solves everything. It reduces risk, so it must reduce problems. Well, not necessarily. When you buy a mutual fund, you're buying small pieces of dozens or hundreds of companies. If even some of those companies are conventional banks, alcohol producers, gambling operators, or heavily debt-financed businesses, you still own a part of that. Even if it's only 2%, ownership isn't emotional, it's proportional. Diversification reduces financial risk. It does not automatically reduce ethical exposure. A diversified portfolio can still be structurally misaligned if it hasn't been screened. Diversification must happen inside a screened universe. First, filter industries, then apply ratio standards, then diversify within what is permissible. Disciplined investors don't confuse spread with purity. They choose intentional exposure, not accidental ownership. Mistake number 3, ignoring financial ratios. You found a company in a halal industry, technology, healthcare, manufacturing, so it must be fine, right? Not so fast. A business can sell lawful products and still be deeply financed through interest-based debt. Islamic compliance isn't just about what a company sells, it's about how it funds itself. Modern companies operate in debt-heavy systems. Without ratio screening, you don't know how dependent they are on riba. That's why scholars develop measurable financial thresholds, debt ratios, non-permissible income limits, purification processes. Not to make the impermissible permissible, but to navigate imperfect markets with discipline. Serious investors examine interest-bearing debt levels, percentage of impermissible income, ongoing monitoring. Compliance is not emotional comfort, it is a measurable methodology. When Muslims move from assumption to ratio-based evaluation, investing becomes stewardship, not guesswork. Mistake number 4, believing there are no halal options. Some Muslims learn about screening and then say, the whole system is compromised. There's absolutely no point. That reaction feels safe, but it's not strategic. Yes, modern markets are complex. Yes, interest is embedded everywhere, but withdrawing completely doesn't stop inflation. It doesn't build intergenerational strength. It doesn't create economic unity. Avoidance is not a wealth strategy. Islamic finance has developed structured screening frameworks for decades. Sharia compliant funds exist. Screening methodologies exist. Oversight structures exist. The issue isn't absence, it's awareness and discipline. Instead of assuming nothing exists, verify screening methodology. Look for structured oversight and apply consistent standards. Imperfect system, clear framework. Strong communities are not built by retreating from markets, they're built by participating with structure and integrity. Mistake number 5, trying to do it all alone. Information about halal investing is everywhere today, but information is not the same as implementation. Companies change, debt ratios shift, funds rebalance, holdings evolve. A portfolio that was compliant last year may not be today. Screening is not a one-time event, it's an ongoing discipline. And beyond compliance, you still need asset allocation, risk management, retirement planning, estate strategy. Halal investing isn't just about avoiding what's haram. It's about building a structured system that aligns faith and financial planning. Structure creates confidence. Apply industry screening, ratio analysis, ongoing monitoring, strategic portfolio construction. Compliance and competence must work together. The difference between casual investors and serious investors is not sincerity, it's structure. And structure is what turns intention into integrity. If you have found the information in this video of benefit, I want to offer you my ebook of the same title, 5 Costly Mistakes Muslims Make When Investing. I'll put a link below in the subscription for those of you who are interested. I also want to invite you to the Qur'anic Wealth Blueprint Community, where we discuss exactly how wealth is perceived in Islam and how we as Muslims can be more responsible stewards of our wealth. I'll put the link to the community below as well. I want to thank you all for sticking to the end of this video. I hope that it has been of amazing benefit for you all. Please don't forget to subscribe to the channel and like, comment, and share the video with others so that they too may gain clarity and confidence when it comes to investing.